We're going to bring up the chart of the history of this stuff happening, right? It's going to come up in a minute. But anyway, it's been 4 days. And at what point do you think sort of the Iranian problem starts to have long-term impacts, if you will, on the markets and everything like this? Before we get to that, I wanted to share this with the audience more in depth. So these are major crises over the years. This is where the market was 21 days later, 63 days later, 126 days later, 252 days later. For the most part, a year later, it's almost always higher. Mm-hmm. But we go through this, right? We still go through this anxiety.
Because people panic. You see the headline, oh my gosh, 20% of global oil production is offline. By the way, Angola going like this, come to me, I got all the oil you want. And let's just be honest. You see this headline, and all of a sudden there is this real widespread panic, coupled with high valuations going into this. So the people have made a lot of money, and all these names we constantly talk about have said, let me take a little profit finally. And said, we've been telling them for a long time. You know what's still up a bunch on the year, even after today? Small cap stocks. Yeah. You know what's still kicking butt, even after down 3% today? International stocks. So for those of you who believed in portfolio management 101, you wouldn't even be worried about today. In fact, it'd be the opposite. You'd be that bottom feeder who's buying when people are fearful, which is what this is about. This is not an economic implosion. This is not look, if it lasted to your questions, forgive me.
Yeah, bring up the other chart while we talk about that so the audience can see at least the effect of a 10% increase in oil prices with inflation. Mm-hmm. And I guess it'd have to be sustained for a certain period of time, not just a flash in the pan.
I'll give it the shortest interval would be about 6 weeks. If we had a 6-week expansion of oil from 60, call it to 76 where we are today, you're probably looking about the average person is going to spend more than $1 to $1.25 per gallon more per gasoline, which means probably we're going to see 25 to 50 basis points come off U.S. GDP. We were above trend GDP going into this quarter, probably going to grow somewhere around 2.5%, maybe even higher. So if we give a little bit up of GDP, it's not negative, it's not recession, it's not layoff. And what it does mean, though, Charles, the one thing we got to be careful about, does it mean a prolonged bout of inflation because of higher oil? And more importantly, what's happening is not oil's going up, but also seeing interest rates push higher. Right. Those two together is why the market's having.
One of the interesting aspects about this is for the last year, we've been hearing the word bubble a lot.
Yep.
And yet we've seen pockets of the market, like software stocks, get hammered. We're seeing this market pull back sharply. That's not an irrational exuberant. This is not a market that's irrationally exuberant in my mind. In some ways, it kind of pushes back against this narrative that the market is unmoored or people are too optimistic about it.
It's just price adjustment. It's normal. We've been doing this for 100 years. We didn't do it for the last few years because it wasn't normal. Now at a time when stimulus is out of the way and you're going back to normal price adjustment, good companies that produce real revenue are selling off if they're expensive. But good companies who produce real revenue weren't expensive are doing quite well. Right. We can go through and pick a list of companies that are still up on a year and up.
So let's look at this then. Here's you still have valuations are still elevated, right, overall. And now you got equal weight, which has come on nicely. But this still, I mean, for me, it doesn't make me afraid. I know purists think they would like to see it come in a little bit more. But again, this seems more like a rational market than an irrational market. Maybe the selling is irrational.
This is the great rotation. The 22 times is obviously all those Mag 7 names. Look at the 18. That's a fair multiple. That's almost average where we've been for a long time. That means you do really well mid-cap stocks, small-cap stocks, especially those with good earnings cycle. There's a chance to rotate from where you've made a bunch of money, buy things cheaper. And when you have these bouts of volatility, if you see a Micron, a great company, down a bunch recently, then you maybe jump into that stock because it's on sale. Good names on sale. But the rest of the market is not expensive. And a day like this gives you opportunity to enter those names.
Let's talk about the economy. Okay, we talked about potentially what could happen if the inflation takes hold. And so recently we've had some data that looks pretty good coming into the year. Consumer sentiment starting to pop pretty good. Manufacturing popping really nicely. I mean, can this be sustained, if this is a relatively short affair?
If you want to course correct American economics and change who we are today, that chart on the right is very important. We have been in contraction on manufacturing for a decade, basically. These 2 months, now it's 2 months, if they're the beginning of a renaissance in manufacturing, you're hearing plant after plant being built, and we get sustained growth above 50 means we're in expansion, it changes the way we are economically, and I'm very excited. Now, this could be inventory restocking. Right. Let's see if it holds.
This is huge, though. This is huge.
This is a very big part of what's happening.
You don't have to be a chartist to look, wow, something is happening here with both sentiment and manufacturing.
That holds on, things will be different.
Let's talk about how to make some money.
Yes, sir.
All right. I know you like Rolls-Royce. Yep. Rolls-Royce Holdings. We've got some of the key reasons, the power systems for vehicles, rearming in Europe, strong earnings trends.
The Chancellor of Germany, who's just on TV today, they're going to spend 3.5% to 4.5% on defense. They need power. This is power for defense and power in general, not just in Europe and to a degree in the United States. But you look at a company that 50% earnings growth last year, 17 this year. At the core of the rebuild in Europe, they're in the middle of it.
I'm going to bring up the chart, though. It's made a big move already. You think, though, it still has more room to the upside?
It's just like your international stocks. This will above trend on international because you have to go to companies like this because they need power there. They don't have enough.
Let's look at National Grid. There's another name that you like here. NGG is a symbol. Again, you know, energy business, high voltage transmission, PE ratio. I know you like those lower PE ratios.
I do.
And strong growth. I'm going to pull up this chart as well because, again, the stock looks intriguing. And I don't want to. So you're okay. It doesn't. In your mind, we haven't missed a move.
That right there is the cold winter we had.
Okay.
So if you want to get, you're probably going to have a better entry point at 80. My point is, in the demand for data centers and the rebuilding of the American electrical grid, this is a multi-year hold. Why? The entire country is going to rip down transmission lines and rebuild them. They're in the middle of that. So it's not just a temporary bump because of a really cold winter. It's about a long-term trend for more power.
It's a buy and dip. So, okay, and Exelon is another name that you like. And again, I think it's an energy play, right? Electrical utilities, the company's expanding, and it's a name. Again, the chart looks pretty good here, but this is for you this is a multi-year hold, right?
It's not only is the creation of power, it's the distribution of power, it's multi-sector power. Listen, I gave you all three power names today because we've talked so much about AI, software. Well, let's talk hardware for a change. Where is the benefit of AI power going to come from here? But it's not just that. We're becoming an electrified society. We need probably 25 to 50% more power over the next 100 years. So in the next 10 years, you need at least a bump of 10 to 15% just for data centers.
Right.
In the middle of it, the movement of that power, whether it's a utility company creating it or moving it, I think is a way to take a barbell in your portfolio. Have safe names in there that are going to protect you in times like this, but also go out and allows you to take risk in other places.
Good stuff. Thanks a lot, Phil. Love it. Appreciate it.